Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of a comprehensive guide to investing in the consumer goods industry. Strategies for investing in consumer goods. The consumer goods industry is a popular choice for investors because it offers a mix of stability and growth potential. Whether you're a seasoned investor or just starting, choosing the right strategy can make a significant difference in your returns. Let's explore some practical ways to approach investing in this sector. Direct stock investments in consumer goods companies. Investing directly in individual companies allows you to have greater control and the potential for higher returns. By purchasing shares of well-known consumer goods brands, you're essentially betting on their ability to grow and maintain market dominance. Pros of direct stock investments. Potential for higher returns. If you pick a successful company, your investment could outperform broader market averages. Dividends. Many consumer goods companies offer steady dividend payouts, providing regular income. Brand familiarity. You likely already know these companies from everyday products you use, which can simplify research. Cons of direct stock investments. Higher risk. Individual stocks are inherently riskier than diversified investments. If the company underperforms, so does your portfolio. Time-consuming. You need to thoroughly research and monitor stocks to make informed decisions. When evaluating potential stock investments, consider these steps. Analyze financial performance. Look at metrics like revenue growth, profit margins, and debt levels. For example, companies with strong cash flow and manageable debt are often better positioned to weather economic downturns. Understand market position. Is the company a market leader or a niche player? Established brands often offer more stability, while smaller competitors may have higher growth potential. Evaluate valuation. Check the price-to-earnings (PE) ratio to see if the stock is priced fairly compared to earnings. Assess future trends. Look for brands aligning with changing consumer preferences like sustainability or health-conscious products. Direct stock investing can pay off if you're willing to put in the work and take calculated risks. Consumer goods, ETFs, and mutual funds. For those looking to spread the risk, ETFs, exchange-traded funds, and mutual funds are attractive options. These investments bundle multiple companies into one fund, making them a solid choice for diversification. Why consider ETFs and mutual funds? Diversification. Instead of investing in just one company, you own a small piece of many. This reduces the risk of a single stock dragging down your portfolio. Professional management. Mutual funds are managed by experts who do the research and adjust the portfolio to maximize returns. Ease of investing. ETFs trade like stocks on the market, making them accessible and liquid. For instance, a consumer goods-focused ETF might include companies like Procter Gamble, Coca-Cola, and Unilever. This gives you exposure to big players across the industry. Key benefits to keep in mind. ETFs often have lower fees compared to mutual funds, making them cost-effective for long-term investors. Both options are ideal for beginners or those who don't have the time to analyze individual companies. ETFs and mutual funds make it easy to dip your toes into the industry without overcommitting to a single stock. Growth versus value investing in consumer goods. Your investment approach will depend largely on your financial goals. When it comes to stocks, most strategies fall into two categories: growth and value investing. In the consumer goods sector, both approaches can uncover opportunities. Growth investing. Growth investors focus on companies they believe will expand rapidly. These companies often reinvest profits into the business instead of paying high dividends. Think of brands innovating in fast-moving areas like plant-based foods or sustainable packaging. Characteristics of growth stocks. High revenue growth rates. Often trade at higher valuations, e.g. high PE ratios. lower or no dividend yields. Examples include niche brands entering new markets or companies in high-demand categories like premium beverages or organic skincare. These stocks may be riskier but have the potential for significant upside if the business scales. Value investing. Value investors look for companies that are undervalued by the market but have strong fundamentals. The idea here is to find bargains, stocks priced lower than they should be based on earnings or assets. Characteristics of value stocks: lower PE ratios compared to industry peers, higher dividend payouts, making them ideal for income-focused investors. Steady, established companies. In consumer goods, value stocks might include large, well-known brands like PepsiCo or Colgate-Palmolive. These companies may not offer explosive growth, but they're often reliable performers with consistent cash flow. Which strategy should you choose? It depends on your risk tolerance and investment timeline. If you're willing to take on more risk for greater potential rewards, growth investing might be your path. If you prefer stability and a steady stream of income, value investing could be the better fit. Ultimately, the right balance may involve incorporating elements of both strategies, depending on market conditions and your overall portfolio goals. By choosing the approach that aligns best with your financial objectives, you can capitalize on the strengths of the consumer goods industry. Analyzing consumer goods companies. When it comes to investing in consumer goods, going beyond surface-level knowledge is crucial. You need to dig into the business fundamentals to really understand how companies operate, grow, and maintain their competitive edge. Here's what you should focus on when evaluating consumer goods companies. Evaluating financial statements. Financial statements are the backbone of analyzing any company. They tell the story of how a business makes money, manages expenses, and deals with debt. For consumer goods companies, key metrics to analyze include revenue growth. Look for consistent year-over-year increases in revenue. This signals that a company is selling more products or increasing prices effectively. Flat or declining revenue could indicate trouble attracting or retaining customers. Earnings and profit margins. Check net income, profits, and examine margins. Gross margin reflects how efficiently a company produces its goods. Higher margins mean they're keeping more of every dollar they earn after production costs. Operating margin shows how well the company is managing operating expenses like salaries and marketing. A steady or improving operating margin is a great sign. Debt levels. Too much debt can overwhelm a company, especially during rough economic periods. Look at the debt-to-equity ratio. The lower, the better. Also, check if the business generates enough cash flow to cover its interest payments, interest coverage ratio. Cash flow. Consumer goods companies with strong cash flow are better equipped to invest in growth, weather downturns, or pay dividends. Focus on free cash flow, the money left after operating and capital expenses. Tracking these numbers over several years helps you see trends rather than getting caught up in one-off results. If you spot a company with growing revenue, healthy margins, and manageable debt, you might have a winner. Assessing brand strength and market share. In consumer goods, branding can make or break a company. Consumers often stick with brands they trust, so understanding the power of a company's branding and its position in the market is critical. Brand recognition and customer loyalty. Big names like Coca-Cola or Colgate don't just sell products, they sell trust and familiarity. A strong brand gives companies pricing power, which means they can charge more without losing customers. Look for companies with clear brand identity and long-term customer loyalty. Market share. Companies dominating their market are often better positioned for stable, long-term performance. For instance, a top soda brand with 40% market share has more leverage compared to smaller competitors battling for scraps. Product innovation and diversification. Brands must stay relevant. Companies that regularly launch new products or adapt to consumer trends, like healthier snack options or eco-friendly packaging, show they can keep up with changing demands. A simple way to evaluate brand strength. Think about the last time you bought something. Was it because of the name? Do you notice the same brands repeatedly in your own household? This insight can reveal a lot about a company's ability to sustain demand. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.